Hi, everybody. Welcome. Hi, everybody, and welcome to another episode of our webinar series. Today, we're going to talk about fundamental analysis. It's going to be fundamental analysis 101, and we're going to look at economic indicators. This is going to be the first out of the two parts that we have on fundamental analysis. We're going to do brief introductions into the main pillars or the main categories of economic data, how to categorize it correctly, and in a sense, get a glimpse of what kind of information these kind of economic releases that come out periodically provide for traders, and how to use them to your own benefit and manage to place trades and capitalize upon these releases and make money out of it. So we're going to make a quick start as I see people start to join. Okay, perfect. This is a quick risk warning and a disclaimer. I'm not going to go over it. The point of this kind of slide is that this information contained within this webinar is for educational purposes only, and the redistribution of the material is strictly prohibited. We're not providing any sort of investment advice or investment recommendations. This is purely for educational purposes only. Okay, so moving on, and we start the session with a lovely agenda. What we will cover in this webinar: overview of economic indicators. That's what we're going to do. We're going to see the different categories of economic indicators. We're going to go over more specifically today over growth and output metrics. And next session, we're going to do inflation. Okay. Also inflation today, and we're going to do another two coming up on the next webinar. Also, we're going to see and attempt to I'm going to attempt to explain and for you hopefully to understand how news releases affect the FX market. Okay. So what are economic indicators? So the definition, in a sense, in a nutshell, is that economic indicators are statistics, plain and simple, about an economic activity. Okay, so since the nature of economic indicators is numerically based, that's the point of it. Fundamental analysts use data that indicators provide. They do quantify it, they do analyze it, and make predictions about the future performance of an economy, of an indicator, of whatever. Okay, so essentially they provide a snapshot of the specific economic activity within the market, and there are plenty of economic releases that explaining or are broadcasting some sort of economic activity within any given market you have. And what we do as fundamental analysts, we piece those information together, and you create, in a sense, a holistic kind of view on how an economy is behaving. And from there onwards, you kind of extrapolate or you do financial modeling about the performance of any given country's currency. Okay, so at the end of the day, we're going to be tying the whole thing of economic releases into reactions or movements in currency markets. So we're going to talk about FX rates. So it's going to be calibrated. These economic news releases, this fundamental analysis webinar, it's going to be calibrated for the FX market reactions that are yielding after these kind of releases or at the time of these releases. Okay, so there are three main types of economic indicators, and this has to do with how potent they are, but also has to do with specificity in regards to time. So leading indicators, that tells you what's actually happening right now or maybe in the near future. So they're most likely there's kind of surveys or a quick snapshots of how an economy is behaving. More specifically, a common indicator that you can call a leading one is weekly initial jobless claims. You also have the University of Michigan kind of consumer sentiment, consumer expectations, and all that kind of stuff. TEF from the zone, from Eurozone, for example, Germany more specifically, has also some leading kind of indicators. They are not a lot of them. Most of them are lagging indicators, the ones we're going to be focusing kind of severely upon. Okay, so such as examples of such as lagging indicators are inflationary updates, for example, CPI, HICPs, PCEs, all that kind of stuff. GDP is also a lagging one because it obviously collects information about what has happened in the prior month or the prior course or the prior year, whatever that is. Okay. And there are a lot of them. Most of them are lagging. And you also have coincident indicators. We have what we call the NFP. Pretty much all of you are familiar with the term NFP. Non-farm payrolls data comes up every first Friday of each and every new month. We also have industrial production rates and all that kind of stuff, which are categorized under the coincident kind of category. Okay, so is for you just to get a glimpse of what we're talking about here. So categories of economic indicators. So economic indicators can be classified into, at least from my point of view, four broad categories covering wide spectrum of data released in the market. And these include what we call growth and output metrics. We categorize this together instead of having five categories. So you can do five actually. But we have done growth and output as one, inflation as another. These two are going to be looking a little bit more closely into this session. We also have employment metrics and consumption metrics. Okay, so these are the four broad: growth and output, inflation, employment, and consumption. So today we will go over each and every one of those categories, present key metrics that fall under each and describe them, interpret their readings, and in a sense attempt to understand how they affect currencies in the FX market. Okay, so growth and output metrics. So the most widely known one is what we call GDP, so domestic product. So GDP is considered to be the broadest measure of a country's economy, as it represents the total market value of all goods and services produced within it during a year. Okay, so everything that was produced by that nation, you get the nominal value of it, you add it all together and you get a number, and that is in a sense compared with the prior one. You have what we call the GDP metric, and you track over time whether that economy has grew or contracted, depending on the situation. So it is the most important growth metric of a country's economy. And in a nutshell, it provides a health status update of a country's economy. So how healthy and how strong an economy is but is shown or is broadcasted by or is presented by the GDP of a nation. So at the end of the day, what we call about GDP, as you just said, so it's the total value of all goods and services that were produced within that period of time, whether that is a quarter, whether that is a month, whether that is a year, okay, of a nation. So rising GDP rates, so it's in percentage terms, signals growth in an economy, obviously. So that means that tends to lead to a stronger currency, because international investors or funds or whatever that is, when they see an economy having strong and higher GDP rates across time, you tend to, as an individual or as an investor or as a sovereign fund or whatever that is, you tend to invest in the economy in order to capitalize upon its kind of growth by setting up business there. And when you set up a business, you hire people to work for you, and you capitalize upon this increasing betterment of things, if you can conceptualize it like this. Okay, so it is attractive for a country to have a strong GDP rate. That leads to stronger currency. So in order for you to move, for example, from your Australian dollars into the United States dollar, because you have a stronger GDP rate in the United States, you need to convert your Aussie into dollars. So you need, in a sense, to sell your Aussie dollars, and you, in order to get the greenback, the dollar. So that is what is strengthening the currency at the end of the day, the transaction, on the hopes that investors and companies and funds are going to be moving capital into the economy in order to capitalize upon the rising growth tendencies and trends. Okay, so that's the gist of it. So falling GDP rates, obviously the complete opposite or negative in some cases, signal an economy is stagnating or is having problems. So therefore that is going to lead to a weaker currency, because money are flowing out of the economy, because the conditions are not ideal or optimal for businesses and investors to make more money. Okay, so that's pretty much the basic kind of connotation or the basic meaning behind how the GDP rate is affecting a currency or not, or a country. Okay, so growth rates, so the rate of economic growth or development of a country is mainly measured by the GDP, as we just mentioned. So news about the GDP become an essential ingredient in shaping investors' sentiment about the value of a currency. So again, stronger GDP rate leads to a stronger kind of appreciation of the value of a currency. Okay, so we just said how that whole thing is actually working. So the importance of economic development statistics in currency trading is evidenced by the fact that whenever an economic data release is indeed scheduled, the currency market, in a sense, hesitate in its price movements initially, but it often moves vigorously or quickly or erratically, if that's the case, when the news surprises the market. So in a sense, you have a GDP reading of the prior quarter, and economists actually come up with a projection of what's going to happen in this kind of quarter. So therefore, you have an expectation. The markets tend to move closer to that expectation, but at the time when the actual release comes out and you had actual numbers coming out, for example, you awaited the United States GDP rate to come 2.8%, and upon the release, you have a rate of 3%. So that's better than expected. So the market has moved. Okay, if you for example assume that in the prior month you have 1.4%, the expectation was it to go to 2.8%, so double, but the actual rate came to 3%, so above what you have expected. So the markets have already moved, taking the consideration that we are going from 1.4 to 2.8. And when the actual result comes out, the 3%, you go even further and you adjust accordingly. So the markets move on expectations first, and then they adjust accordingly the course of their action and their assessments depending on the result. Okay, so that's how pretty much each and every market works. Not only FX, but also gold, but also crude, but also energy market, metal markets, commodities in general, and all that kind of stuff, equity markets as well. So you see equities rallying on not the beat of earnings or the EPS or the revenue targets, but on the forward guidance or the forward outlook that the company releases in its statements, its earnings statement. They say, okay, we've done this in the prior quarter. Okay, fair enough. Who cares? We've already passed this. It's already incorporated in the price. Now, as investors, you see what's gonna happen, what the company expects to happen in the next quarter, because you're looking into the future in order to get your next estimation, your next expectation, your next target. Therefore, that's how what leads pretty much each and every currency move, or any given move in other instruments in the markets in general. So the expectation theory, we have discussed that in prior webinars. Okay, you can go ahead and look and watch exactly what we have said about this in prior webinars to refresh your memory. So essentially, the market moves based on expectations and adjusts accordingly whenever deviation occurs between the actual result and the expected. Okay, so forecasting and the actual and the prior one. Okay, so GDP, as we just said, the most well-known growth rate in the field. So the rate measures the change in the market value of all final goods and services produced within an economy in any given period of time. We said this 5 times so far. Okay, if you have questions, please send them through. I'm more than happy to elaborate and explain myself further. Okay, so the rate can be expressed on a month-on-month, quarter-on-quarter, or on a year-on-year level. So it's a broad measure of economic activity and the primary indicator of an economy's health. So interpretation, how to read these kind of statements, you can find these kind of releases in any given financial news kind of website. This is what we call the calendar. This is a snapshot of 2 releases from a calendar within any given period of time. Okay, so how to interpret it. Also, we have to get the components straight. So the currency, so we're talking about the pound and the Japanese yen. So this is from the United Kingdom and this is from Japan. Importance obviously high because this is GDP reading. So we have GDP quarter on quarter for the 4th. Okay, so that was for 2023, which came out sometime in March or April. And this P means preliminary. That means the first estimate. You have sometimes second estimate and third estimates, etc. Okay. Also, other factors that we have in order to read this kind of the information is that you have actual, the forecast, and the prior one. So previous, obviously, that's what it is. Forecast is what the market expects it will happen prior to this kind of release. And the actual is the new result, the actual result. Okay, hence the name actual. Okay, so in this kind of case, we have from the United Kingdom, the prior quarter, so Q4 or Q3 of 2023, the GDP rate of the United Kingdom was -0.1%, so contraction, that means shrinkage. Okay, the forecast was it for it to stay the same. Okay, at the end of the day, it's not good news anyways, but the actual one, okay, was -0.3%. So that means the situation worsened. What would you expect to happen to the pound? Obviously weaken. Okay, that's how you read these kind of things. Same thing goes for the Japanese yen. Prior quarter was 0.8%. Expectation or the forecast was for it to move for contraction into expansion. So from the negatives into the positives, 0.2%. That did not happen. We have -0.1%. So the reaction is always going to be, is expected to be negative for the Japanese yen. Okay, so going past the GDP, let's move on to another super important economic news release, which is the PMIs, the Purchasing Managers Indices. So what is it? Okay, Purchasing Managers Index is an economic indicator that surveys. Okay, they go out and ask people, what people, purchasing managers, the ones that are responsible for buying or giving out or coming up with the orders that are going to come in the factory, let's just say, of raw materials in order to create a good, okay, or a service, depending on the situation, because it's most of the times we're going to talk about manufacturing. Most likely we're talking about things or raw materials or materials that I need to get processed in some way or form that are going to create a new kind of good that is going to be sold, and it's going to, depending on how much it is and how much it's worth, it's going to contribute to the GDP reading. So PMIs are surveys from purchasing managers, okay, as we just said, at businesses of a given sector, for example, the manufacturing sector of an economy, and investors use the PMI surveys as leading indicators. That means it gives you information about what's going to happen in the near future or is happening currently, because we're talking about the things that go into businesses in order to create a good or service, okay? So if you have higher PMI readings, that means there is more demand for these kind of goods and service. So the purchasing managers are feeling much more optimistic and buying more stuff. Therefore, most likely it's going to lead to a higher PMI reading, which at the end of the day, if you see higher and higher PMI readings, that means there is business going on, there's growth in business going on. So that means probably it's going to lead to a higher GDP rate and a stronger currency. You get the idea, okay? So the PMI surveys are leading indicators of economic health, and these surveys are usually released ahead of official data. So that's why it makes it a leading indicator. So the indicator survey, the manufacturing sector and the services sector as well, and the combination between the services and the manufacturing provides us with what we call a composite PMI figure. So manufacturing and services together, you get the composite PMI figure. Also important, but we tend to place a little bit more importance on some economies, manufacturing, and some economies, services sector. And we will see that on the second paragraph. So the importance of each sector depends on the structure of the economy. So for example, the United Kingdom's services sector tends to outweigh or overweigh the importance of the manufacturing sector, because the GDP reading, the contribution to the GDP reading of the services activity in the United Kingdom is much higher than the manufacturing. Therefore, we place much more importance on what is contributing the most to countries' GDP. Not that we do not give a damn about the manufacturing sector, for example, of the United Kingdom, but we do place a little bit more importance on the services front, okay? Mainly because the majority of the countries' GDP is produced by the services sector, and we talked about the United Kingdom. Now, in contrast to the UK, another example that has a little bit more importance than the services sector is the manufacturing one of China, more specifically. Also, you can see Germany with the same kind of pair of eyes. So Chinese economy is the manufacturing sectors tends to be a little bit more under close watch, because China is a manufacturing powerhouse. We're talking about the largest nation when it comes to creating stuff, manufacturing stuff, at least, no services sector. So yeah, we tend to pay a little bit more attention, or a lot more attention, on the Daixing and the NBS kind of releases of the manufacturing PMIs, okay, in order to get a better grasp of what's going on with the Chinese economy. Now, we should bear in mind that the indicator bears a reading on a scale from 1 to 100, with a reading of 50 being the cut-off point. So between expansion and contraction. So above 50 is considered to be growth phase, whereas below 50 is considered to be contraction phase or shrinking phase. Okay, so expansion and contraction of economic activity of the particular sector is being defined by either below or above a 50 reading. So closer you are to 100, that means superb growth. Closer you are to the value of 1, that is no good news as shrinkage. Okay, so it should be noted, however, that some analysts also like to watch a historical change across time, not only the actual result coming out. Given that it's a consecutive drop in figures, even though being above the 50 level, so For example, if you see a PMI reading coming down from 65 to 63 to 60 to 54 to 57 and then back to 52 or whatever that is, you see a downwards kind of trend, signaling that there is growth in the manufacturing sector, services sector of the economy is worsening across time, even though you are not below 50. Okay, you tend to look at that as well, the seasonal kind of trend of PMI readings from a kind of zoomed out perspective. Okay, so overall, a larger than expected reading tends to provide support for the currency for the reasons we just mentioned. So stronger PMI, that means stronger GDP. So stronger GDP means more in appealing economy, more funds are flowing into that economy. Okay, so that's the reason why. So we have here 3 releases, one from the United States, one from China, and one from France. So we have from the United States the ISM non-manufacturing PMI. That means the services sector. Services sector of the United States economy is larger than the manufacturing one. We do pay a little bit more attention on that. So what we have here is previous month was for the month of August was 52.7. Expectation what is for it to slow to 52.5. So some sort of worsening, but a little bit slower. Not worsening, but slowdown of the acceleration, if you will like. So less growth, slightly less growth. Actual figure was above both of them. So superb reaction for the dollar. Money flies in the US economy after such strong readings. Okay, so we went from prior quarter 52.7 to 54.5. Okay. Next up, we have the Taixing, the manufacturing PMI of China. Also, the 49.2, that means it was in contraction territory. Expectation was for the contraction to slow down from the 49.2 to the 49.3, but the actual result was above the 50 level and above expectation, so much quicker kind of acceleration. That is also super good because we crossed the 50, but we also escaped the 49 slight delay. So growth in that month in the manufacturing front when it comes to China was much better than expected. Flows into the yuan are expected in the FX market. Lastly, we have China, we have France and the services activity PMI, or more specifically, so 47.1 contraction, not good. 47.5 again, not good, but still better than the prior one. The actual one was much worse than expected. Okay, so it went below the 47, it went to 46.7. Okay, so weakness of the euro was reasonably expected after this release. Okay, and this is what we mean by the historical evaluation of the manufacturing PMI or any given kind of indicator. Anyway, you see the trajectory is moving south, so that means we have far reached the peak, and then from there onwards you slow down up until this point where the arrow is ends the 50 level. So we were at expansion growth, yes, but slow down of growth. But after this kind of period of July of 2022, we see contraction. So not only growth has stagnated, but instead of growing, we are actually contracting now. We are shrinking. That means there's not enough demand, or there's workforce going out of the door. So there's a lot of factors affecting the PMI readings. That reflects either optimism or pessimism. So below 50 is pessimistic. So that's definitely not good news. And whatever this currency is, which is for Germany, paradoxically, it's the manufacturing powerhouse of the zone. You see that is in deep trouble. Okay, and it's going to take a lot for it to get back to its feet. Okay, so the long-term trend of the euro in this kind of case, given this information, we have a bias towards a weaker euro, and we have seen that actually. Okay, so next up we have what we call industrial production. So industrial production is a measure of output of the industrial sector of the economy. So industrial sector includes manufacturing, mining, and utilities. Okay, 3 main categories. So it should not be confused with the manufacturing sector's output growth rate, not the same thing. Industrial sector has utilities, mining, and manufacturing, and it's also another lovely output kind of measure that we like to pay close attention to. interpretation. So the acceleration of the growth rate beyond the market expectations, okay, above forecast, tends to provide support for the currency and provide versa. So Chinese, we have China here. Industrial production of China for the month of August. Previous one was 3.7%. Expectation was it to rise to 4%. Went better than that. So it went 4.5%. Strength for the yuan was expected. And we have here industrial production of Eurozone, Germany, and Japan. As you can clearly see, in the Eurozone, we have a lot of bad kind of readings time after time again. We see struggling. We see the European kind of manufacturing function being some sort of lacking here. So from negative 1.1%, we then to negative 2.2%. So double contraction from the prior month. Definitely no good news. Weakness for the euro was expected. And finally, what do we have here? We have industrial production from Japan. It was in positive territory. Expectation was it for it to contract 1.4%. It was even worse than that. So 2% negative contraction. That means the Japanese yen was reasonably expected to be weaker post the release of this kind of data. Okay. Also, we have another indicator called durable goods orders. So durable goods orders reflect new orders placed with domestic manufacturers. Okay. People that actually contribute and create stuff for immediate and future delivery of hard factory goods, such as fridges, electrical appliances, submarines, trains, airplanes, whatever that is. Those are durable goods. Those are stuff that you construct, you build, and you sell. And those are actually buy once, let's just say. Okay. You know, we're not talking about clothes or shoes or food or whatever that is not lasting long. Okay. So we're talking about things that are made with the purpose of testing the surviving the test of time, if you would like. Okay. So the indicator is also made under different names depending on the source of the economy, is considered to show the confidence placed by businesses and their willingness to actually invest in long-term assets in their economy. Okay. So it tells you indirectly how those manufacturers are looking at things. So if they're not buying, if there is no strong durable goods orders kind of sales, that means there is not enough demand, or because of the higher cost or whatever that is. This is not good news for the long-term kind of trajectory or path of the economy, because you don't have new orders of things that actually matter and they last for quite a while within your economy. That's certainly not good news. So also please note that there is expressed as a headline rate, which is described down below, while also we may find a core version which actually used to or tends to exclude transportation costs from an equation in order to minimize the possible effect of oil prices. Okay, so core version excludes something, headline is the entire of the thing. Okay, so should we see the rate accelerating beyond market expectations, tend to provide support for the currency. No surprises there, because you get much more orders for durable goods within your economy. So stronger durable goods orders, that tends to lead to stronger kind of currencies. And we have here the United States durable goods orders. We have the core, which excludes transportation, but we also have durable goods orders, the plain one, or the headline rate. And what do we see here? We see an acceleration from the 0.2%. The expectation was it to stay the same. It did not. It came better than expected. So 0.5%. Good news, strength for the dollar. And when it comes to the durable goods orders, we have 4.4 in the prior month. And then we fall into contraction. Expectation was moving from 4.4 down to negative 4%. Okay. So we have an 8.4% drop, if you would like, of durable goods activity. That was the expectation. The actual result was negative 5.2%. So we're talking about 9.5% of a drop, of a contraction, actually. No good news for the dollar. So if you put these two together, mixed reaction at best. So enough about growth and output. Let's move on to the next category, which is inflation. Inflation. We have been hearing about this over the past 2 years now. What is inflation? So it is essentially the rate at which the general level of prices for goods and services are rising. Okay, the stuff you buy at supermarkets or online or whatever that is tends to increase over time. This is inflation. That is telling you, in other words, that what another way of conceptualizing it is that the measurement of the loss in the purchasing power of the every unit of currency that you have. For example, that means let's just assume that inflation is at 10% on an annual basis. That means essentially that a loaf of bread that costs $1 in 2021, in 2022, when you have 10% inflation, okay, that means you are now gonna pay $1.10. Excuse me, for the same item a year later. So in a sense, you have less money to buy the same thing 1 year later because of inflation. That's the way to conceptualize this. So as you may know, the majority of global economies have faced rising inflationary pressures and rapid changes of inflation or deviation from a benchmark rate in 2022, 2023, which forced central banks to make changes in their monetary policy stance, i.e. hike rates in order to contain inflationary pressures. And now we are at a stage where enough was made. So a lot of rate increases have occurred within 2022, 2023, and now in 2024. Central banks, most of them at least, are ready to start cutting rates, start reversing the situation to allow the economy to breathe. And you will see when we win here. Okay, so CPI is the broadest and the most basic measure of inflationary pressure. So this is the most well-known kind of measure for the rise of consumer prices in the consumer price index, also known as the CPI rate. So it's a measure of the average change over time in prices paid by consumers for a set basket of goods and services. And the annual rate of change of CPI is usually referred to as the inflation rate. So in other words, CPI, HSCP, PCE, whatever that is, we talk about inflation. So the rate is measured on a month-on-month basis, on a quarter-on-quarter, but also on a year-on-year kind of level. Excuse me, guys. So implications, what does it mean? So an acceleration of the rate beyond market expectations tends to provide support for the currency, while a deceleration below market expectations or even a contraction tends to weaken it. Okay. So we have here from the United States a CPI and a core CPI. Core CPI excludes volatile food and energy prices. And the last one is from the United Kingdom, just a plain CPI. So previous 3.2, expectation 3.6. So rise of inflationary pressures. Actual came out 3.7%. Much more strength was expected from the dollar after this bit of expectations. So 0.2%, 0.2% expectation, 0.3% was the rise. Okay, so CPI from the United Kingdom, 6.8% expectation was it to rise to 7%. Actual one was 6.7. So negative reaction for the pound was expected here. Okay, core CPI, same thing, but excludes volatile food and energy prices. And the reason why we do out the food and prices because price of oil may be indeed manipulated by cartels of producers such as OPEC Plus or OPEC, or can be potentially weaponized, much like we have seen back in 1973. While at the same time, fresh food may be sensitive to weather conditions and natural disasters, but also the seasonality effect. So that's our analysts and investors prefer to focus on what they perceive to be the core or underlying rate of inflation. Okay, so you may look at both, you may look at one of the two, depending on you. They have some sort of different implications, if you like, but at the end of the day, that's pretty much the same thing, excluding two parameters, food and energy. And it's exactly the same way of reading this. So a possible acceleration of the rate tends to provide support for the currency and vice versa. Okay, how many more do we have? I have 3 slides. Let's go over them quite quickly and we will be finishing this session quite soon. So HICP, the Harmonized Index of Consumer Prices, comes only from the European Union, the Eurozone. So in the Euro area, consumer price inflation is measured by the Harmonized Index of Consumer Prices, also known as HICP. The term is Harmonized denotes that all of the countries of the union are using the same principles and standards and procedures to come up with a result, which is much more easier for investors and traders and economists to look at the holistic number, knowing that the process was the same. The process of computation of this kind of rate is measured correctly by the same kind of algorithm by all the member nations. Therefore, you can rely on that data. So overall, the rate is considered to be superior to national CPI rates. So we're talking about the Eurozones here, as it makes them directly comparable with each other and allows the calculation of inflationary pressures in the Eurozone as a whole also being comparable. Okay, so acceleration beyond market expectations provide positive support for the euro. On the contrary, weaker or below expectations kind of HICPs that leads to weakness for the common, okay, weakness for the euro. Same way you read that we have read the prior ones. So CPI, preliminary CPI for the month of August from Eurozone, 5.3 is the expectation. The forecast was for a slowdown to 5.1% level. Actual one was 5.3. No major reaction was expected after this. Okay, so same kind of rationale. So the core personal consumption expenditure, the core PCE is the Fed's favorite inflation metric. We probably have heard about this so far. So the personal consumption expenditure, the core PCE index measures the prices paid by consumers for goods and services without the volatility caused by movements of food and energy prices, because it's core PCE. And this tends to reveal the underlying inflation trends in the US economy. It is considered as the Fed's favorite inflation metric, along with the CPI rate, are sorry guys. CPI are also important, but most people tend to place a little bit more attention on the core PCE because that's what the Fed uses in order to make their policy decision. Okay, again, same dynamic here. Acceleration beyond market expectations could provide support for the greenback and vice versa. So if it's above expectations, positive. If it's below expectations, this is negative, and it has different implications on how the central bank behaves upon this. Okay, so historical data of US core PCE index, what we see rise of the PCE at the start, sometime halfway through July of 2021, rise and peak above the 5% level, struggling or some sort of consolidation taking place, and then we have moved lower from here onwards. So obviously this is not ideal for neither the economy nor the Federal Reserve. So in this kind of case, you see the broader kind of picture going from here onwards. Okay, so finally, the last slide, we're going to talk about producers price index. So far we have been talking from the outpost of the consumer. Now we're going to talk about the producer. So the producer price index, aka what we call PPI, is a different ball game. So it still measures the rise of prices, but for producers, not consumers, like the prior rates priorly mentioned. So it measures the average change over time in the selling prices received by domestic producers of goods and services. So as we mentioned, PPIs measure the change from the perspective of the seller, okay, as opposed to CPI, which is measuring price changes from the consumer point of view. And their importance also lies or relies on the idea that should businesses suffer continued price increases over time, so PPI moving higher and higher and higher, at some point in time, these businesses are going to pass on these kind of price increases to consumers, okay? So finally, acceleration of the rate beyond market expectations provides support for the currency, while a deceleration or contraction does indeed weaken it, and you can clearly see here. Okay. That brings us to the end of today's webinar, guys. If you do have any sort of questions, please send them through. If not, we're gonna keep it here, and we're gonna see you during next month or next week's kind of webinar next Friday. So I don't see any sort of questions. That's okay. Thanks for watching, guys, then, and we will see you hopefully on next Friday for the continuation of this slide. Take care. Bye-bye.